Welcome to the FarrCast, providing you insight into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week, July the 24th. Here we are, end of July, coming in here, middle of the summer, maybe past the halfway point. Kids are going back to college in about 3 weeks. I don't know how all of this happens, folks. I keep complaining about times passing. You think that's a sign? I don't know, but there sure is a lot going on. I hope you're getting some time off, getting a break, getting the recharge the batteries. There's a story on CNBC.com today. It's one of those sort of human interest things that seems to always get more clicks than the actual financial and economic things. And CNBC seems to get that, and they keep running it. But it says, here's the one thing that really intelligent people do. So, of course, I clicked on it like everybody else. And it says they take a break. They take a break. They find times of quiet. They find times of reflection. We hope that you do too. Get those breaks out there. Congress is going on break. Congress is going on break early. Why? Well, sometimes if you don't want to deal with the work on your desk, you just get up and say, I'm going on vacation. Apparently, if your boss, in this case, the Speaker of the House, goes, yeah, I don't want to deal with it either, everybody gets up and walks out. So here's a great American walkout. We're walking out early. We're not going to deal with the stuff, and it will be there when you come back. So, if it's going to be there when you come back, do take some time off, whether you like Congress's timing or not. Make sure you get a little timing for yourself. In the meantime, stocks are making new all-time highs. Dow Jones Industrial average over 45,000. Wow. That's incredible. It's incredible. And it's a tremendous validation of American capitalism, of our free market economy, that things grow in this country and happen that don't happen anywhere else around the world. But as things are moving to new highs, you should be feeling cautious. You sell high, you buy low. And it always feels better to be buying when they're making new highs, doesn't it? When you feel good, when your portfolio's increasing and you think, geez, I should have had more money in those stocks that are going up. Duh, as my friend Harry would say. I'll give him the big duh for today. So, what do we do? I was thinking about a friend of mine who gave a rather bearish argument at the Berkshire Hathaway annual meeting years ago, explaining why you should short Berkshire Hathaway. It was about 10 years ago. Buffett and Munger invited him. He made a very cogent, rational, detailed, plausible argument as to why you should short Berkshire Hathaway. It was dead wrong, horribly wrong, profoundly wrong. And it occurred to me that you should think about those things that you hear on television, you read in different articles that sound totally logical, totally plausible. They just don't happen to be correct. And they don't happen to work out. They can get your attention. And they maybe shouldn't. And what should? Fundamentals, earnings, balance sheets, and strong companies, perhaps with expanding market shares. We used to spend a lot of time on TV talking about the TAM. We've got to pay attention to the TAM. It was the buzzword du jour about 5 or 6 years ago, a little phrase, little acronym for total addressable market. And if the total addressable market was expanding and you had a company that was growing, you were in the catbird seat. What do we do with all of this? We're going to go right to Jim Lebenthal, Cerity Partners, CNBC contributor, my friend who is always in the catbird seat. And he, too, is just back from a bit of a vacation, and his desk is as full as I suggested it would be. Welcome back, Jim.
Thank you, Michael. It's a great welcome to be back here. Thank you. A lot to unpack in what you just talked about. Should we?
I got a bit windy. You start anywhere you want.
Well, let's talk about, I'm going to phrase it, the dangers of being too bearish. You can be bearish. You can see the pessimistic side of the markets or any particular stock or investment. In fact, it's wise to do that to make sure that your overall bullishness is tempered by what can go wrong. But, a friend of mine, I don't think you've met Ben Pace. He's our chief investment officer, really great, gregarious guy with a ton of experience. The way he phrases it is when people get really bearish, it's like they go to the dark side of the force and they never come back. And what happens is they wake up every morning looking for things that are going wrong, whether it's the stock that they're short or the markets overall. And you know what? I've done it. I've shorted stocks before. I've been out of the market and watched it go higher, and you just feel like a dope. And you start concocting more and more reasons for why the market should go down. The interesting thing is, you might be right from an intellectual point of view, but this is not a science contest. This is a making money contest. And you've got to figure out how to make money in the markets. Being bearish generally is not going to work. If you're a salmon swimming against the river current. But that doesn't mean that you just have to blindly throw your money at the markets. There are many ways to balance the concerns that somebody may have, whether it's about the heights of the market, the valuation, with the long-term growth potential of the equity markets. And what I would say to start with is, I think it's probably not helpful to look at market multiples to say, oh my goodness, we're trading at 22 times earnings, we have to go down. You may be right in the long run, but earnings can continue going up and that multiple can stay right where it is. The market can continue going up and you're just going to feel worse and worse and worse. To summarize what I'm saying and not make this, a filibuster, try to think about staying in the market for the long run. It's what you and I, Michael, always talk about. If the markets go down a little bit, don't get freaked out. Don't say, oh, I should have sold because the market was at 22 times or, earnings are being revised lower. There's a lot going right in the economy right now that can support this market going higher. Let me pause there and see what you want to throw back at me.
Okay, Jim, I like this emotional side of investing. And I've never been able to be the short seller. Okay, I don't have the long-term temperament for it. I can't just go and I'm not negative enough. I'm an optimist by nature. I've always been an optimist by nature, and so I've always felt at times a little bit of a chicken. Somehow intellectually a little SLOW that I haven't been able to be as smart as those guys who short sell stuff. And they all seem so smart. The negative sounding stories all seem smarter somehow. They get more attention. And when I listened to you talk, I just thought, sitting here, I thought, why in the hell does anybody really go short and stay that way and choose to be negative when you recognize that long-term truth that stocks over time go up? If the damn things go up over time and you can get on that bus of the upward moving stock market, why are you trying to be so damn smart and playing what I think is Russian roulette at times to sell short a stock? And when you sell short a stock, ladies and gentlemen, you have an unlimited downside, an unlimited downside and a limited upside. If a stock's selling at $20 a share and you think it's going to 10, you sell it, which means you borrow the stock and you sell it. And they will put the money in your account and they will actually charge you interest for the loan against that pile of money. And if it goes down to 10 from 20, you can buy it back. You can buy it back and you'll take half the money out of your account and buy it back because you sold it at 20 and now you buy it back at 10 less the interest. And therefore you just made that amount of money. You get to keep the amount of money. But what if it goes to 30? Or what if it goes to 40? If it goes to 40, you've now lost, you've had to borrow it and you've got to come up with all the money, and it can keep going higher. Stocks can keep going higher. You get it wrong, you go higher. I had a guy tell me years ago that Netflix made no sense according to the numbers. This was 10 years ago. He was short over $1 million worth of Netflix. I said, you're out of your mind. He said, why? Let me show you these numbers. I said, I don't care about your numbers. I understand that the numbers of a growth, new company, tech company, new concept always look like that. New companies always, that are really growing in growth phases, always have no balance sheets and they're too speculative for investors. but that doesn't mean that they won't have balance sheets, that they're not on their way to having balance sheets and earnings and things that are respectable. So, Jim, I guess I'm going to just go ahead and agree with you here and not agree with you. I think you do have to be cautious, though I'm not disagreeing with you there. You have to be cautious when the market's making new highs. You do have to pay attention to the price you pay for fish and price to earnings multiples. But longer term, you cannot be negative on the growth of this country. I don't think. I mean, but I back to the short sales. I don't get them.
Yeah, and I think if we're talking about short sellers, hopefully most of the people who are listening to us, Michael, are not engaging in that. It's incredibly dangerous financially, emotionally. It turns you into a negative person. I mean, I've done it, and you just wake up hoping for bad things to happen, and I don't like thinking that way. But let me be a little bit more constructive to our viewers about what you might do in this market if you're a little bit nervous about multiples or value or where we are overall. And this is very simple, and I do this. Trim some of your winners. Now, notice I use the word trim. I don't say sell. Don't take whatever your top, winner is, if by virtue of their performance recently have grown to be very outsized in my portfolio. Simple risk management says take a little bit off of those positions. Retain the core position, and it can be sizable for the long run. But now here's where the art comes in. Once you trim a little bit of your winners, sit on your hands. And I mean it. There's this urge that we all feel of, oh my
Right.
goodness, I've got coins in my pocket. I better put them to work. Nope. Just sit on your hands, let that cash sit there. We're in earnings season. Any stock can get mispriced because of how the market temporarily perceives 1/4's worth of earnings or 1/4's worth of guidance. Just wait for the pitch to come to you with some cash on your balance sheet. Now, I want to be very careful here. I just said a second ago, and Michael, you and I have for years said, don't time the market. The difference between timing the market and what I'm saying right now is the size. When I do this, I never build more than 10% of cash in my equity portfolio. If I go further than that, I am timing the market. Below that, I'm just building up a little bit of dry powder that I can put to work when a particular stock or sector or the market overall comes to me. And I want to further not I don't want to get into wordsmithing here, but this is basically risk management. All I'm doing is delaying the difference between when I trim a stock and when I buy a new one. It's not, I'm not building up cash because I think the market's going lower. I'm simply delaying the recycling of the proceeds from my winners into who my next winners will be.
And with all due respect to Jim, when he talks about 10% and more than 10% being market timing, that's a Jim rule, and that's part of his discipline. Others might have a higher cash balance that they're comfortable with. Certainly, Warren Buffett does. Warren Buffett,
Sure.
who is now retiring, of course, from Berkshire Hathaway, and Berkshire Hathaway's stock is faltering a bit, but part of that seems to be that they have this huge amount of cash that they have to put to work, and the huge amount of cash on which they can earn only, 3 or 4% somewhere in treasury bills or other liquid assets. Maybe they can earn 4.5, but fine, it's a huge amount of cash that begins to be just a really big drag over time. Buffett is very clear in his discipline and has been over the years that if they don't have a better opportunity than cash, they will hold cash. He's comfortable doing it. I think it's a great rule. I think it's a great rule, at least. I think you can even say there's another discipline. Harvard used it for years. They'd have most everything just indexed to the S&P 500 and would buy individual names to the extent that their conviction said that we were going to beat the S&P 500. So if they had a stock they thought was really going to outperform the S&P 500, and that's just another guess, even people from Harvard guess. People from Princeton know, but people from Harvard guess. Uh, See, Lebenthal went to Princeton. I'm just sucking up now.
In a
But
different millennium.
so yes, but the point from Lebenthal and Farr here is that people who make money in the stock market are not making short-term decisions. They're making long-term decisions to own things that are growing in market share, growing in value, growing in power. and and you just get along for the ride. Companies that are continuing to grow. If you've owned Microsoft as an example for the past 30 or 40 years, you're pretty happy. Not every year. Not every year have you been happy owning any of those stocks, but over the whole time, you're pretty happy. Final word, Jim Lebenthal?
I think looking forward at this great country, we've obviously been through some turmoil. I honestly think that it can work out from here. I know that people's nerves are on edge, shall we say, frayed, whatever the word is. But I want to encourage people to realize that the long arc of this country's history shows that we make progress, we improve, we get better, things get better. And I think they will here. I'm primarily speaking economically, financially, profit-wise, but I do think as a society, we can and probably will get better.
I remember meeting you about 15 years ago. Uh, and I remember, and I'm wrong about this, I remember at the time thinking, I don't think Lebenthal could get any better than this. And yet he has for 15 years. Ladies and gentlemen, my friend Jim Lebenthal from Cerity Partners. Thank you, Jim.
Oh, you send me into the world with a big smile on my face, Michael. I'm truly blessed to be your friend. Thank you.
Be an optimist, Jim. Optimists make money, and they help the rest of us. Coming up, folks, Dan Mahaffee. We'll see if he's going to go on vacation too this summer. Hell, everybody's going on vacation. When we come back on the FarrCast.
Three, two, one.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. Here we are coming into the last week of October. Three, two.
Do you want to be right?
Where did that come from?
I mean, we can just save this for.
Might as well. It never changed that much. Three, two, one. Welcome. Oh, God.
Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, Dan Mahaffee, president of the Dr. Scholl Foundation, scholar at the Center for the Study of the Presidency and Congress, a Washington, D.C. think tank, and the senior political analyst on the FarrCast. Welcome back, Dan.
Thanks, Michael. Good morning.
Good morning. Dan, Congress is leaving town early. We don't want to deal with any sort of votes on subpoenas of things for the Jeffrey Epstein situation. And I'm all sort of struck by your remarks from a couple of weeks ago, saying that Congress would stay in until they passed this big, beautiful bill, and Congress would do anything for any threat except for a loss of their vacation time. Now they're getting extra days off. I mean, I'm sort of like thinking back in school when they'd say, well, hell, if everybody makes above a 90 on the test, we can take an extra day off at Thanksgiving time. You can leave early tomorrow. We'll have extra recess for you. Well, they just got extra recess, both perhaps an incentive, a thank you and an incentive, and we don't have to deal with the tough stuff till we come back. But is it sort of a strategy here in both sides of the aisle to delay and wear the American people out? Just talk about something so much and for so long that you just get sick of it and say, can we please move on? Because I just can't take any more of listening to you people talk about this.
Yeah. I think, Michael, to answer your question, we'll get to that more on the Senate side where they have stayed in session, because there is that kind of wearing down trench warfare strategy going on right now when it comes to nominees, particularly because the Senate hasn't yet gone on vacation because there's a backlog of nominees for President Trump's administration. House, on the other hand, yes, vacation was early. They've done the one big beautiful bill. I actually, the best I've heard, let's just call it the OB3. It's the easiest way to do it. So OB3 and all its various tax implications and other things. Folks are figuring that out. they need to go back to the districts and sell some of these benefits because certainly Democrats are going to be hitting them on some of the cuts that are in this legislation, as well as the rescissions we talked about to things like PBS, other government programs, things of that nature. So the House, look, they also are patting themselves on the back about passing the Genius Act, that we now have a some sort of regulatory framework, at least to start moving forward on stable coins. And look, there's a debate about stable coins versus central bank digital currencies that's going to be back there in the background. But all of this really, frankly, to get everyone home was because we didn't want any more votes on any more Epstein business. And that the speaker, looked at the fact that even though the administration had said they were going to release the grand jury transcripts and information, that really wasn't up to the administration. It's up to the courts, and the courts aren't about to break precedent on that. So in the House, there was a mess unfolding on Epstein, and the speaker said, let's just pack it up and go home and pat ourselves on the back on what's been done. And so they're going to do this. It's the traditional campaigning back in the district time, getting ready, the summer parades, barbecues. Don't forget, for our members of Congress, very important fundraisers that they have to go to. But look, they're home and happy
still, right? I mean, there's still a lot on the agenda coming up, including a budget,
Correct.
and that's
Yeah, we're starting to see some of the presaging of that. One that, are Democrats going to be willing to work with them on any deal of this or in any way? Because frankly, for the Democrats, after what you've seen with the rescissions and other spending cuts, there's no goodwill. There's no reason to help. It's actually, I think, going to be hard for the Republicans too when you get down the road to this. One, because you have yet to paper over the differences in the Freedom Caucus, that group, the far right, but also what are the sweeteners for any of the other cuts and things that need to go through? Look, the tax cuts, the no tax on tips, the no tax on Social Security, all the goodies have been in the OB3. So if you're going to be pushing through more cuts to more programs in the next budget, what is there going to be to give to the moderate Republicans or the others that you haven't already given up?
Oh, there's a capital
this
gains tax cut that they're talking about. There's a big capital gains tax cut that's being brandished about in Washington right now, and I'm so frustrated, ladies and gentlemen. We are operating at a deficit. We are spending close to $2 trillion a year, more than we have in income. We're adding to the debt to $2 trillion a year. Now, ladies and gentlemen, if you are not bringing in enough to cover your bills, hey, let's cut our revenues even further, is your approach. Let's cut the revenues even further. Point number two. You're worried about inflation. So you're going to leave more money. Hang on. You're going to leave more money in the economy and not take it out in taxes, which will allow real estate to flourish. But guess what? At higher prices. Guess what higher prices are? That's inflation. So how are you going to solve this problem unless secretly you're trying to figure out how you're going to devalue the overall debt? And you do need inflation, and maybe, oh, do we know anybody in real estate and politics? Maybe we just want to see real estate go up with this cut in capital gains. It's all very frustrating to me, Dan, but is there a chance they could actually get a cut in capital gains?
I don't think we have at least the contours of that and at least scoring it, but it is the proposal. It's being batted around, but this all, as you say, goes onto the national credit card, and I think the envelope we get mailed each month is pretty thick.
It's pretty thick. Okay, Dan, so we're on hold with more of the same, but we're on hold, and the Senate is going to sit and wring its hands, but probably not do too much or so.
No, I think legislatively it's challenging for the Senate because again the priority is to get these nominees through, and this is a bugbear of mine of either party. Look, let the president put his team in place every year. we have this every new administration, every 4 years, that there's this delay in getting the government staffed. But right now, given the lack of goodwill in the Senate, the Democrats are making sure that each one of those nominations takes as long as possible to move through the Senate floor.
Okay. So as I'm going down my list, looks like we've got trade deals. Some of them are getting done with tariffs in Japan and others. Canada seems to be moving forward, but not quite close yet. Tech industry, if you're in the tech industry, you seem to have kind of a smooth sailing situation for right now. You're not in the crosshairs. US and Russia negotiations. Is any progress being made there? And we've got folks starving in Gaza, and so let's move and
Yeah.
talk about China, and then we'll wrap up here.
Yeah, no, I think around the world, look, that trade deal with Japan, the administration will likely want to use it as the model for a lot of others, but let's also have some caution and understand what makes Japan unique compared to some of the others, given the close defense relationship, the auto industry, and the fact that the Japanese were willing to announce pledges of more than $500 billion in direct investment in the United States as part of the deal. I don't think many other economies will be able to match that. And it's an even question that I hear the South Koreans are asking themselves right now. What kind of investment number can we provide, given that our GDP is a fraction of that of Japan's? So those things are underway in those discussions around the world. Look, the besides. And look, we even hear the rumors and stories that Trump has lost patience with Netanyahu. How many times can we hear that he's lost patience with Netanyahu and Putin? And hopefully at least see some action come out of that loss of patience. But, other than this big shift, we see that, that we're willing to send Patriot missiles that European countries buy, send them to Ukraine through European countries after their purchase. Certainly that helps the Ukrainians. I also think there's a rhetorical shift behind the scenes when Trump begins to ask Zelensky questions like, do you have weapons, or what kind of weapons are needed to hit St. Petersburg or Moscow, just so that, Putin might feel some of the pain, or in Trump's sense, do Muscovites need to feel more of this war for Putin to feel pressure? So,
Will Muscovites even hear that message, number one? And does Putin ever feel pressure?
yeah, questions I think we've discussed and answered many times in this show, that he exists in his own sort of incentive structure and in a very, very sheltered way. But ultimately with Russia, it becomes staying the course. And if you do believe the numbers that were actually just put out by the Swedish central bank study, that Russian inflation is running twice, if not 1.5 times more than the official inflation rates given out by their central bank. So how long the Russian war economy can go on without hyperinflation remains a question. And then does Trump really try and put some more economic tariffs on there? That's sanctions, not tariffs.
Moving right along, no progress with China, progress with China.
Look, I think China, as Besant said and Lutnick have said, it's the question of how do you delineate at what level and what line. If you imagine a line exists somewhere, above that line are semiconductors and microchips. Below that line are soybeans and tube socks. So
Yeah.
how do you focus on opening up more of the soybeans and tube socks while still having some reasonable discussions about these? Because look, there's great reporting in the Financial Times. You can easily buy these NVIDIA chips in China on black market. All these export controls seem to be doing is enriching risk-taking middlemen. So how that gets resolved, and whether those are tightened, or how does this become negotiated, I think we remain to see that. On the other front, though, with China, I think of note, Xi Jinping just met with a huge delegation led by von der Leyen from the European Union. Kind of an interesting diplomatic angle. One, he made the Europeans come to Beijing, and two, the Chinese reduced the summit from 2 days to one. So if you're reading between the lines, one, Xi's refusal to go to Europe, as well as the shortening of the summit in diplomatic language that shows you how much esteem or lack thereof Beijing has for Brussels and the European Union right now.
So Xi has given them the flat palm of his hand, is what we're hearing for now. Not a lot of progress there. He sounds about as sensitive as Mr. Putin as well to public criticism and the cares of the world. Right. Let's go to Gaza, and then we'll finish up. We're hearing horrible reports about starvation in Gaza. Tell us what's going on there and what you think will happen.
Look, I don't think this situation of the starvation in Gaza gets resolved without direct pressure and intervention by President Trump on the Israeli government. So much of this is part of.
Why should the U.S. have to pressure the Israeli government to stop the starvation for these individuals? This I don't understand.
Well, because frankly, because otherwise, I fear, in my analysis, that the Israeli government and that of Bibi Netanyahu sees his political survival, as we've repeatedly discussed on the show, sees his political survival as dependent upon small right-wing religious parties, and within those parties' platforms is the reclaiming and settlement of the West Bank and Gaza.
I got that part. Do people have to starve?
I tell people to look at their rhetoric of what they say about the Palestinians and leave you to draw your own lines.
So that's your way of saying yes, according to Netanyahu. Apparently they do. Well, that's as horrible a thing as I've heard. And sadly, I think you're probably right. Dan, thank you so much this week. We always learn so much, and we look forward to a little peace and quiet here with Congress out for a week or two in the summer. Maybe we can all go on vacation for a little bit. I'm not counting on it, but maybe. Thanks for being with us. And by the way, Dan, if you didn't get a chance to listen to Jeff Lacker last week, we are getting cards and letters from economists all over the world saying it's one of the best things they've listened to in any lecture anywhere. Just happened to happen on the FarrCast, but boy, last week with Jeff Lacker, it was a 12 out of 10. Huh? 12 out of 10.
Fantastic, yeah.
Yeah,
Really,
very, very lucky.
I learned more about the Fed and its operations and the history than I knew I could learn.
I agree. I mean, I kept asking him questions to which I thought some of them I got the expected answers, but last week I got more than, well, I'll be damned. And he said it. That's what it was. I'll be damned. He said it. It was great. It was great. Sometimes it's better to talk to a former Fed governor who is not as concerned about the consequences of his remarks. You can learn a lot more, and I think we are. Thank you, Dan.
Thank you, Michael.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Thank you for joining us on the FarrCast. And now, back to your host, Michael Farr.
Welcome back to the FarrCast. Great FarrCast as well. I like Lebenthal. Get him back from vacation. He's still feeling pretty cheery. He's not overworked yet. That worked out pretty well to get a fresh Lebenthal back in there. He's always that voice of reason to me. He's a bullish voice of reason. And I always put Lebenthal in that category in my mind. I know he's going to be upbeat, but I have to add that extra filter. My friend Doug Cass, whom I admire enormously, is always bearish. He is. And he's smart as hell. But I have to listen with that filter because I'm trying to get to the truth. This is like switching back and forth between Fox and CNN, ladies and gentlemen, and then sitting there going, okay, what do I think now at the end of the day? If you want to find the middle of the road people who are thoughtful, who really come up with insights, middle of the road, and not to mention very bright and very cheerful, you try to find people like Shelby McFaddin. That's who you try to find. And lucky for you folks, we found her this morning. She's back. Senior investment analyst at Motley Fool Asset Management. She covers an existing portfolio, degree in economics, and she's just one of the greatest folks we get to talk to. Welcome back, Shelby.
It's a pleasure to be here, Michael. I'm always excited to see you guys on the calendar.
Well, we're excited too. Shelby, we started out talking with Lebenthal this morning, a little bit about folks who like to short stocks and the overall benefits of, just kind of being long stocks over time. And from our perspectives this morning, and disagree with any of this stuff, our perspectives this morning, not selling, not trading too much. But we also talked about shorting stocks. Tell us your thoughts about the market and shorting stocks. And then I want to give you an exercise about headlines for the S&P 500 short. But first, tell me what you think about the overall long and the overall short idea.
Yeah, I think when you're looking at investors who are trying to have a long-term gain from short investing, it's a similar sort of ethos to the regular long-term investor. They understand the fact that the dynamic that they're trying to tap into is not going to be paid out right away. But then there is the short investor who's saying, I'm trying to capitalize on an event. I would say arguably that's harder because unless you're looking at a very specific sort of an issue with a filing, which again, with the free flow and the fast flow of information, everyone's aware that there's a problem with a filing, that there's an investigation. So it's going to be difficult to sort of make your profit off of that. So it's more challenging in the short term than the long term, but you have to really commit to all of the ups and downs. So when you are a pure long-term investor, you're seeing these sort of peaks and valleys and you're saying, you know what, that's okay. I look back over 5 years and I'm up 7% on this position. I look back over 12 years, I'm up 15% on this position. I'm content to keep holding. When you're short, if you've got one period where the S&P is just so much as up 4%, depending on if you're going ahead and saying I'm shorting the whole market, that's a pretty big problem for you. Your horizon is getting longer and longer compared to the average long-term investor. So when we're picking stocks, we might choose something that is a 7-year hold, right? And that's still considered pretty long. And that runway might have been brought forward by just the way the market is moving. We may say, let's go ahead and close this now. It's gotten a little bit frothy and we're going to come back to it. But when we open those positions, we're thinking about them as 10 plus, right? When you open up a short that you need to be, or rather you need to have a long-term view, a very long-term view, you have decided to hold on to a contrarian point of view for a period of time beyond what the optimistic long investor is most likely thinking for what they need. So the sort of gold standard term is, what can we do in 10 years? You're short the market for 10 years. Friends, that's only a couple of business cycles. You really have to have it on point to not miss the top or bottom of that business cycle for the sake of your own profit.
So are you saying that a short is something that really does need to be traded? It can't really be held for the long term?
You can hold it, but you have to be aware of one, what the purpose is and what you expect. So if you're running a sort of hedge of sorts, so if you're running a sort of like hedged equity portfolio, things like that, and it has a functional purpose, then that's one thing. But if you're thinking to myself, I'm planning to make the same return as the broad market by shorting the broad market and a few other, let's say, sector-focused indices or stocks, that's going to be extremely challenging to do over the long term, and it's a lot to manage. So if anything, the psyche is that it requires a lot of grit, and you have to be able to turn the other cheek to what the market is doing pretty frequently, because if you don't, you could be out of a lot of money pretty quickly.
Okay, just for fun, let's say that you were going to go short the S&P 500 today. You're going to go short the whole stock market today. What would be the best headlines you could wake up to tomorrow morning? What would be your best headlines if you were short the whole stock market today? Go ahead, give me a few.
Well, I'll tell you what, and I don't say this in jest, it's just the truth. We have had multiple wars, and it's not disturbed the stock market. We've had multiple announcements of tariffs, and they have really not disturbed the stock market. I mean, we're talking about just a fly that kind of, buzzes past your eyebrow while you're asleep. You twitch, you go back, right? At this point,
I love that. I love that.
It's for me, it's recession, because what does that mean? If the headline tomorrow says we're in one, as in we have observed the prior quarters and it is here, ladies and gentlemen, to me, that's your party line. Because at this point, we have been prophesying recession for the better part of 3 years now. It's not happening. The bears are deeply upset. Everything that we expected to happen is not coming true just yet. We are still dealing with a robust consumer. The banks have not indicated that they're struggling yet. And so at this point, waking up and seeing we are in a recession, we have the multiple quarters of data to prove it. If you're short, it's your lucky day.
Yeah, and but just think, you'd really have to have those horrible headlines if you're going to be short. You have to have a pandemic. You
Yes.
have to have a recession. You might want the wars. You might want all of the other stuff that could shake the market. You don't want sunny days. I mean, it's
No.
just something I don't wouldn't know how to do. So, but yes, more insights on shorting, how difficult it is, and why I've done it before. I basically did it so that I could learn what it was like to be short, and I didn't like it. And I can't remember. I don't think I made or lost much money one way or the other. So probably got lucky.
That's pretty
Yeah.
good.
They say you shouldn't make money on your first options trade. And if you're really sure something's going down, folks, you're not, number one. Number two, buy puts. Buy puts. You contain your losses when you buy puts to the downside. When you go short, you have an unlimited downside.
Yep.
So you can buy puts if you want to hedge the downside at a certain known expense. All right. Shelby, we're seeing a market that's trading at all-time highs, over 45,000 on the Dow, S&P, making new highs. Are you still constructive on stocks for the balance of the year? Do you have concerns? Some of the earnings estimates are coming down, but in the middle of the year, they typically come down. Earnings so far seem to be pretty good. What are you guys seeing? What are you seeing? What's Motley Fool seeing?
I think at this juncture, the short answer is yes, we are still constructive. And part of that is because what's the alternative, right? We are active equity investors, so we're in this game regardless of how bumpy it's going to get. So when we think about the fact that there's a lot of uncertainty in the market, with companies thinking, okay, what are going to be our losses with regard to tariffs? Can that be offset with any gains when it comes to other tax policy for corporates? And how can we make that work to our advantage and to benefit our shareholders? So when we realize that all these things are happening to everyone in the market, and that's just sort of a level change, it doesn't make us less excited about trying to continue to pick stocks and own high conviction names that are going to outperform their peer group because of their specific skill set. So everyone is going through something. They're going through what the broad market is going through. They are moving through the business cycle at the same time, but we are able to identify them as high performers, as sort of those bigger planes that don't feel as much of the turbulence, as opposed to what we call the puddle jumpers, where it's two seats on each side. They're about 20 rows, and you're going to feel every ounce of cloud as you go through the sky. So trying to find those big jetliners that allow us to fly a little bit more smoothly. It doesn't clear the storm, but it makes the ride a little bit more comfortable.
And yeah, you're not right about all of those all the time, are you?
No, I mean, sometimes you're going to get it a little bit wrong in the medium term. You're going to suffer a little bit. Sometimes you have an operator that fails to pull through, and sometimes you get that headline or that 8K that says this person's out. And sometimes that's really good news. But being a long-term hold allows you to also reap the benefits of knowing that might have been brewing up, right? We've had some smaller companies where we saw a really great vision. They had a little bit of change of leadership. We said the thesis isn't broken. Let's sit tight. Then we kind of watch things roll along, and you see, you know what? I want out of this. Lo and behold, they get rid of that person. You're already out, but now you have an opportunity to come back in because you realize what the potential could be for that position. So beyond the not being able to time the market and not being able to time things like announcements of tariffs or what an entire administration is going to do, we can at least pay really, really close attention to operators, and the best we can in terms of what they give us publicly. Most companies are not going to talk about their heads of R&D beyond what you're hearing with pharma and things like that. They have to constantly tell you about things like their FDA approvals. But if you're talking about a CPG company that has lotions and whatnot, you don't really hear that things aren't going super well in R&D. You don't hear that the lead scientist is not being super innovative, if you will. I'm a stock picker, not a scientist. So, that's something that maybe comes out a little bit after the fact, and you can't always control it. But we try not to get too wrapped up in the sort of 1 to 3% blips in these really, really big, mature companies that are multinational and at the point of mega cap.
Right. We know that they need R&D. We know that, but you're not seeing the headlines. Hey, we've got a great new toothpaste or face cream or moisturizer. Great.
Right.
That's not going to move a stock price. So
No.
might be good for them, but right. This is not the hot stuff. It is the more boring stuff. Over time tends to work out. I remember years ago, and I'm sorry, ladies and gentlemen, I can't remember the man's name. I think it was Gould. And he was a very famous investor 30 years ago. And 30 years ago is about the time when I could still remember things like that. And he said, and I was asking, I said, so the secret to being as successful as you've been in the stock market, come on, tell us. And he said, oh, that's easy. I never sold anything. I never sold anything. I said, what about your losers? He said, nope, didn't sell the losers, but I didn't sell the winners.
Yep.
And that's work. And I loved it, Shelby. I love that. I was like, I bet if I'd never sold, and one of the exercises I have done, still do, I go back through the list of stuff I've sold. I go back years and look at, and I keep the list of stuff I've sold, and I write down the reasons why I've sold it at the time. And God, they look like stupid reasons. Some of them look like stupid reasons 5 months later. Most of them look like stupid reasons 10 months later.
Yeah.
And occasionally that you look at one and go, well, thank God I got out of that. But I kind of like what Mr. Gould said. So the I Love Lucy show, Lucy, Ricky, and Fred and Ethel. Fred and Ethel were the middle-class landlords. Can you give us your final words of advice to Fred and Ethel here in the middle of the summer with tariffs and headlines and things going on with Russia and Epstein and Israel and Gaza and China and Xi Jinping and everything else? And Fred and Ethel are saying, my portfolio looks okay. Shelby, what do I do?
Well, it's going to be a little bit of a two-parter because it really matters. Trust me on this one. If Fred and Ethel, if we're talking about the 40s, 50 middle age, that's a different answer than what some of the younger folks think when someone might say middle age. So realistically speaking, Americans are living longer, they're healthier, especially if they're wealthier, right? So if Fred and Ethel are in their 80s, it's a little bit different. We might say, go ahead and de-risk a little bit. Don't lose faith in the stock market. Go ahead and keep some of your investments. But by this point, their advisor, hopefully, has helped them de-risk into a lot of income, right? And so, yes, we do know that bonds are not the safest, they're frankly, they're a little bit too exciting lately, place to be because yields are a little bit elevated, right? But there are a lot of shorter term instruments, and because rates are a little bit elevated, they can use cash instruments in their favor. Assuming that they've had decades long of compounding, they're already a bit de-risked. But if we're talking about the Fred and Ethel, I think we're talking about where they are kind of about 50 to 65, there's still some risk there. If they don't have any other sort of long histories that would affect their health that they were concerned about, they've got a lot of living left to do. They've got a lot of compounding left to do, not just income taking. So we would say stay a decent amount in the market, right? You go ahead and you take that retirement glide, especially if they're not working, right? But be not completely afraid of the US stock market. The business cycle is a few years long. Administrations are a few years long. There are different things that take a little bit longer to clean up or put back together or rebuild. But in light of all these headlines, being steadfast and realizing what's driving the market, and one of those things is secular change. We've all heard the thing over and over again, AI, AI, AI. There is froth. I'm not going to sit here and look you in the eye and say there's no froth and we should believe all these valuations. But there is still a structural change that is coming to the overall market. due to the productivity that we are going to gain from some of these major innovations in AI. We've yet to see them all yet because some of them are tangible, what they can do, but the productivity they bring is yet to be seen. And some of them are just going to be shaken off. You know what? We appreciate it. It's not helpful. So we still have a few years to see what that's all going to look like. And that's one of the reasons I think it's worth staying invested in the market is there is structural growth yet to come. And the United States stock market has gone through, dare I say, tougher things than this, right? We have had much worse inflation. My parents' generation, teens for a mortgage, and we're over here bemoaning 7%. It's hard when your neighbors have 3%, but as an econ student, 7% on a good credit mortgage is, in my opinion, kind of where the economy ought to be. Shouldn't be too easy. You give everything away for free, you get what? Inflation. I could do this all day. So to Fred and Ethel, I say stay invested, stay steadfast, de-risk according to your plans for retirement and your cash needs, but now's not the time to walk away from the stock market.
Absolutely brilliant. Shelby McFaddin, senior analyst at Motley Fool Asset Management, actually a manager there and the pride of George Washington University. We're so glad to have you on. Thank you so much for being with us.
It's a pleasure. Thank you both.
That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world, bringing you experts and insiders every week so that we can better understand what's going on around the world around us in the headlines, in the economy, and then in our markets, and what we need to do about it, which, as you've heard over and over again, what we have to do about it is very little more than stay the course and have a long-term plan, disciplined, dispassionate, and seek some advice when you need it. We'll be back again next week, doing it all over again. Hang in there. Have a great summer. Do get out and take a break. Get some vacation time. For Harry Jennings, our producer, and everybody at Farr Miller in Washington, thank you. Please share us on social media. If you didn't listen to Jeff Lacker last week, please get that one and go listen to it. You'll be smarter, I promise. I'm very grateful to each of you for listening. Rehoboth Beach, Delaware, I'm Michael Farr. See you next week.
That's a wrap for this episode of the FarrCast. Thanks to our guest, Jim Lebenthal, Dan Mahaffee, and special guest from the Motley Fool, Shelby McFaddin. And thanks to you, our listeners. We hope you enjoy listening to the show as much as we enjoy making it for you. Please share us with friends and colleagues. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Apple Podcasts, Spotify, and TuneIn. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance here at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course across the changing investing environment. We are grateful for all of your notes and comments, especially on last week's double segment with Dr. Jeffrey Lacker, and we try to respond to as many as we can. Please keep those emails and messages coming. We'll be back with you next week. Until then, take care, stay safe, and stay healthy. I'm producer Harry Jennings, and thank you for listening to the FarrCast, Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller, and Washington and Hightower Advisors LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors LLC or any of its affiliates. Farr, Miller, and Washington and Hightower Advisors LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.